Joining us right now to talk about strategy ahead of all of these events is Matt Toms, he's CIO of Fixed Income at Voya Investment Management. Also, Kathryn Rooney Vera, Kathryn Rooney Vera, head of research and chief market strategist at Bulltick Capital Markets. Good morning to both of you. Let's start with you, Matt. Ahead of all these numbers, I don't know, you focus more on the numbers, you focus more on the Fed, first of all?
The Fed's first. We need the Fed to stay ahead of the market expectations. The steepening of 2s, 10s is useful, up to 18 basis points. Finally, the Fed's not behind. The Fed will cut this week and then look for one more early next year. But the key is to keep ahead of the market.
And what happens if they don't?
If they don't, I think you're going to see a pretty negative response. You've seen the dollar weaken a bit. That's helpful. You don't want that retrade higher in the dollar. And the global bond structure has been trying to move higher in yield in Europe as well. So this would be the Fed fighting the market if it did it. We don't anticipate they'll do that.
Kathryn, you think they will or they won't?
Of course the Fed is going to cut rates, Joe. I mean, when has the Fed not cut rates when Fed fund futures are pricing in more than a 60% probability of said cut? So the Fed is married to the market expectations. The Fed will cut. That doesn't mean that the Fed will cut the three additional 25 basis points that are currently priced in. But Wednesday they will. I agree. I think that if the Fed doesn't cut those 3 times, it will be a negative reaction by the markets. If the Fed even sounds slightly hawkish this week and indicates that it may not have to cut, which it really doesn't, 3 times in total, then the markets will not like that either.
Okay, so
that
Kathryn,
said, I do think that we're going to have record highs.
I think it cuts this week, but that the commentary is going to be a little bit more hawkish than the market wants, in which case it becomes a problem. Therefore, my question to you is, if we're in the same place, what are you doing about it in terms of how you set up your portfolio ahead of all of this?
Yeah, it becomes a problem for the markets, but yes.
Yep.
Yeah, it becomes a problem for the markets, but it's actually a boost to the credibility of the Fed. So, yeah, look, I think what I've been telling my clients is it's a really good idea to protect your upside, protect your returns. So you pay, volatility is very low right now. You can buy a March expiry put option, which gets you through multiple Fed meetings, Iowa and New Hampshire caucuses and primaries, first week of February, and Super Tuesday. So you can get through both political risk and Fed risk, which, by the way, I think is the most important risks in the market right now. It's not trade war. It's not U.S. recession. Those 2 narratives, I think, have been pushed to the back burner. And in fact, I've been outside of the recession camp for some time, and I do think we're going to get a framework deal, as I've said, for a very long time with China. So buy some put options. You just forfeit less than 4% of your return. To buy that put option, you protect yourself, and you don't have to be outside of the markets. Worst case scenario, Joe, you just let that put option expire.
Matt, you agree with that?
I think there's too much passive money on the sideline right now. There's a lot of caution in the system. People have made a good amount of money this year. I think the pain trade is actually to see equities push higher, bond yields a bit higher as well, and start to crowd in some capital that's looking for the clock to run out on the year, and it says nice gains. Look for people to be pushed in.
Hold on. So you think that the Fed's going to cut and the market's going to go up on that, or you think it's already baked into the cake?
I don't. I think the yield curve can steepen more. I think you've got areas of weakness in the senior bank loan market, for example, that will take a cue from the Fed and from earnings not being a problem. I think you can crowd quite a bit more in.
And then real quick, just in terms of earnings, because I know we keep having a conversation about whether a recession's coming, whether the numbers will be good. So far, the numbers have been pretty good. The question is really what you think the guidance is going to be from a lot of these companies that we're hearing from today and throughout the rest of this week, and what that portends for the next quarter and the next year. Matt?
Yeah, guidance continues to be subdued, but still positive. So an earnings kind of morass is not the worst case scenario. We get some abatement on Brexit and trade, and I think that early next year you can turn a bit more positive.
Kathryn, are you positive for 2020?
Yeah. Look, I think what Matt is talking about is that trifecta of what can produce a melt-up, which is, of course, a trade deal, which is, of course, continued earnings growth, pointing to a very strong picture, and Fed cuts. So what is a melt-up? Can we get to 3,100? We probably can, but I do think that going into 2020, with the volatility in the markets, with the political risk coming from the left and the Democratic side, from the right with the impeachment process, from a Fed that perhaps disappoints the markets, I just think it's prudent to protect your gains. And it's not something that we're saying liquidate your portfolios. We're saying hold on to your S&P. We do think you can go higher from now through year end, but I think 2020 is worthwhile to get more defensive.